Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, before we went on air, we were talking about what a hell of a week it's been and how you got pretty much everything wrong. But you seem in good spirits and pretty chipper, so talk us through the trades of the past couple of days.
Yeah, look, at least I'm not Heineke Meyer this week, so I wouldn't want to be him. But certainly it hasn't been a good week for us either, and I've also got a lot of explaining to do, because you're right, last week I pretty much got everything wrong on the show. So let's have a look at what happened and explain it and try and take some positive out of it, because there actually are lots of positive aspects to be taken out of what happened last week. So the first thing I want to talk about is last week's short trade on SAB Miller, which must be the most awfully timed trade that we've ever done on this TV show. Anyway, you know, these things happen. What happened is that I looked at the chart, which is up on the screen at the moment. SAB Miller had broken down below this upward trend, which goes back about a year and a half. It had fallen. It was rallying back up to test the underneath of that trend. And to me, it looked as if we were going back down and basically going to go back down towards about 580 Rand. And technically speaking, that's you know, it's textbook stuff. And I would, if you gave me that trade 10 times over, I'd do it the same way all 10 times over. What I also identified was that the stock had broken down below the bottom of this range, which was a 630 to 680 Rand range. And that also projected lower targets down towards the 580 Rand area. Then, of course, what happens is we get this massive spike up here, and that was caused by the announcement that Anheuser-Busch InBev would be looking to make a bid for SAB Miller. Now, I want to have a look at just zoom in on that area that I've boxed on the chart there. And I want to have a look at an hourly chart of SAB Miller to show you in more detail. And this shows you the hourly chart. It goes back basically to the beginning of September. So every candlestick pattern that you see there is 1 hour's worth of trade. And here, this big spike is effectively, that was the announcement of the of AB InBev wanting to make a bid for SAB Miller. And you know, for all intents and purposes, this actually is a black swan event. And if you look very carefully at that chart, you can actually see a black swan there. All right.
Sort of like the vomiting camel.
All right. No, but I mean, look, jokes aside, that certainly was a black swan event. There's no doubt about that.
Well, I mean, yes, this time last week, we were sitting here quite chuffed with ourselves. The trade was working out really nicely, but then it started rallying up the share price in the afternoon, and it was that morning that everything started happening.
Well, that's right. So let's quickly have a look and see. Now, what I'd identified was that on the hourly chart, as well as on that daily chart I showed previously, there was this rising wedge pattern, and the price had started to break down to the bottom end of that rising wedge pattern. Now, that is a sell signal to go short, and I took that opportunity. We went short of 200 CFDs at 633 Rand for last week's show. My stop loss was 650 Rand, and I was looking for a move down to 585 Rand. We decided to risk only 1% of our capital on this trade. And because I've said that things are so volatile at the moment, it's better to scale back the size of your positions a little bit in this kind of market environment. So we did that. What happened then is that last Tuesday when we sat here recording the show, it was down here close to 600 Rand, and we were looking good. We were up about 5,500 Rand on the trade as at last week's show. But then it started to tick up quite sharply into the afternoon session after we had finished recording the show. And rumors had begun to surface at that stage that there might be a corporate action around SAB Miller. And now look, these corporate actions have come and gone every year for the last couple of years, and they've always been
Nothing's actually happened.
Nothing's ever happened, and eventually the share price has just gone back down anyway. But the one thing I do know is that when these rumors surface, you don't actually want to be short of the stock. And that got me a little bit worried. The next morning, these rumors became a bit louder, and I decided at that stage, pretty much on the open, on the Wednesday morning, that I'd just cut the trade. I don't like to see a winning trade turn into a loser. And it started trading up above our entry point of 633. So I closed it literally in the first 2 minutes of the day when the market opened. I closed it out at 634 Rand. And it resulted in a very small loss. After transaction costs, we lost 792 Rand, which was 0.22% of our capital.
Which is nothing.
It's nothing. It's absolutely nothing. And I don't know, call this a blink moment, if you like in the book by Malcolm Gladwell called Blink. You just sort of think, I've got to be out of this trade, exit. And I didn't really think much about it. I just thought, no, I need to be out of this trade. And look, then shortly thereafter, we saw the announcement coming out, and the stock traded all the way up to about 760 Rand. Now, we were very fortunate. I was in front of my screen at the time, early in the morning, to close this trade. I could have actually nipped off to the toilet for 5 minutes and missed that big spike. And realistically, that could have happened because it moved so very quickly.
Okay, so if that had happened, where would you have been? What would have happened to the portfolio?
Well, this is the point. And this is what I want to bring, the positive aspect of this. And this is the focus on risk management and specifically the importance of position sizing with risk management. Let's assume that we had only managed to close out that trade at 750 Rand, up there where it settled, and which is, unfortunately, to say how many people experienced this trade. What would have happened then? Well, then we would have lost 23,500 Rand of our capital. That would have been 6.6% of our capital. Now, a couple of things here. Look, first of all, 23,500 Rand is a big number, but also, if we had lost 6.6% of our capital, that is still not a catastrophic loss. You've still got 93.4% of your money left. It's still a strong position to be in. You can still trade your way back to profitability from there. So the point is here that not only did a stop loss save us, but also, even if we had missed the stop loss, the correct position sizing would have meant that even in the most extreme kind of black swan event like this, we still wouldn't have been carried out on our account. We actually still would have been in a relatively strong position anyway. So I think there's a lot of positives to be taken from this kind of scenario, and specifically to illustrate the importance of position sizing as well as your use of stop losses in a case like this.
And it was an extreme event. I mean, no one's ever seen a share like that do 20% in a day.
Yeah, it's very rare.
Okay, guys, so then, unfortunately, that rally in SAB Miller then hoiked up the entire market. So while you were sitting really sweet last week with your put option structure against the market, which was a short options essentially, then that also turned around and not in your favor.
That's it. So last Tuesday we sat here, this option structure was sitting at around about just below 44,000 points. We were right in the sweet spot, and I sat here and I said, we've got the Fed on Thursday night and they're not going to hike interest rates probably, but market's going to be very, very lethargic up until then. So the likelihood is we're going to close with this thing perfectly in the money.
For futures closeout?
Yes, for futures closeout. Well, of course, that didn't happen. As you said, the SAB Miller announcement came out. SAB Miller on its own, it had about a 11 or 12% weighting in the top 40. That 20% movement up in SAB Miller accounted for more than 1,000 points gain on the top 40 on its own, just the one share. And of course, what that then also did is it pushed the market up through a whole bunch of put option strikes. So all of a sudden, there was this massive short squeeze because all the short positions that had been entered to hedge written put options at sort of 45,000 and that area now needed to be bought back, and the market just went higher and higher and higher. And the end result was that the market closed out on Thursday at 46,340, which meant that we went literally in a day from being perfectly in the money with this option structure. We went completely out the money to the point where we made nothing. In fact, we lost our premium of 3,500 Rand. The only upshot, I suppose, is that you recall we did go long of the IG markets, top 40 cash CFD, and I did 2 of those. So, and this is the micro contract. So the 2 Rand contract, and I did 2 of them. So it's 4 Rand per point is what we were effectively exposed to. And I let that run out to close out and then close those out with the futures close out. So in the end, I sold those out and we made 8,892 Rand off of that. So I suppose that is some consolation.
Yeah, a bit of a silver lining there to your incredibly bleak 2 days.
It is. But unfortunately, the 2 trades, the SAB Miller and this option structure, have resulted in a fairly significantly, quite a bad negative movement in our portfolio. You'll see at the end, our portfolio has lost about 6% for the week.
Yeah, okay. I mean, but that's still not disastrous. No. So you haven't been cleaned out.
No, certainly not.
Okay, so unfortunately, a lot can change in a couple of days on the market. Yeah. Now, Garth, interestingly enough, you've decided to once again put on another put spread structure for the portfolio heading into the December close.
Yeah, look, I still maintain my somewhat bearish view on the market generally. I don't like the structure of a lot of these overseas markets, or our market for that matter. And that big push up that we saw into the futures closeout on Thursday afternoon, I actually used that as an opportunity to now re-enter another put option structure for the December closeout. Okay. So this will run out to the 3rd week of December. So let's go through it. It's quite a complicated one because it's a put spread structure, but it's also funded with the sale of a short call option. So 4 legs to this structure. So this one's even a little bit more complex than the others that we've done in the past. But nevertheless, I think this is a really good structure, and I'm very pleased with the way we've managed to get this one. Along the bottom axis here, we've got all the levels on the top 40 index. So we start at 38,000, 39, 40, 41, and so on. And then here we've got on the left-hand axis, profit above the line and loss below the line. Now, what I've done initially, I've gone long of one contract of a 46,000 strike put option over the top 40. For that, I've paid 16,374 Rand. To equate that into points terms, that's about 1,600 odd points that I've effectively paid as a premium for this put option. Now, that's all very well. It'll continue to make money from 46,000 down. It'll continue to make money all the way down to naught. Now, the market's not going to go to naught, so we can sell away some of that downside participation and be realistic about it. So what I've done in order to recoup some of that premium, now I don't want to pay that full 16,000 Rand if I can avoid it. So what I've done is I've sold short one contract of the 43,000 strike put, and there I've received 7,008 Rand for that. And I've sold short another one contract of a 41,000 strike put, and for that I've received 3,974 Rand.
Okay.
All right, so I received premium on both of the short sales of those two put option structures. I've further to that done another one where I've sold short a call option now. Now the call option strike is 50,000 in this case. And I've sold one of those, and for that I received 3,881 Rand. So I know it's quite complex, and if we overlay the payoff of the overall structure now, it looks like that yellow line. Now I know my colleague Andrew said to me this morning, this thing looks like the London Tube.
It does actually.
It looks like yeah. So let's simplify it, just tidy it up a little bit. That's what the overall payoff would look like on this put option structure now. Effectively, what it means is that if I take the premium that I've paid for the 46,000 option and offset that with the premium that I've received on the short sale of the other puts and the call, then what it means is that above 46,000 Rand, I've paid 1,511 Rand.
Which is
it's nothing.
Quite
it's 0.5% of our portfolio, so it's really nothing. The structure starts to make money below 46,000. It makes a maximum profit of 28,500 Rand between 41,000 and 43,000. And the nice thing is the structure only starts to lose money below 38,000. So it gives us a very, very broad area of profitability on this structure. The other area it loses is if the market were to go above 50,000, it starts to lose there as well. But I can't see that happening. I think between 38,000 and 50,000 at each end of the extreme, I think we're quite well covered. And I really do think that if we are going to be weak into the end of the year, this is a very, very nice structure.
Certainly the market's looking very shaky today. Garth, you talked about, having got a really good structure and the premium paid is actually a very low price. Is it because of the market rallying so much on that Thursday last week that you managed to pay away a small premium?
It's that, and it's also because volatility is quite high at the moment. And when you sell options, and when you buy them, but volatility is a big component of the pricing structure of options. And you get what's called a volatility skew. So the further to the left-hand side you go, in other words, lower down the strike spectrum, the greater the volatility levels are.
Yeah.
So because I've sold out the money put options, I've sold the 43,000 strikes and I've sold the 41,000 strikes, I get paid a very high volatility level for those because the skew is quite sharp at the moment. And that's why I've been well paid for the sale of the short put options, which allows me this ability to get quite a wide profitable zone.
Okay, well, let's see. Hopefully there are no black swan events in the December futures closeout. Guys, so what does the portfolio look like then, taking that all into account?
I'll show you that. Sorry, this is one more diagram quickly, and it shows you just the top 40 graph with the payoff profile illustrated there. You can see it gives us a nice broad profitable area. All right, then the portfolio right now, look, at the moment, this put option at the bottom is the only position we have open now. All these others are closed out. We've got 346,000 Rand in the account, so that's up 38.5% for the year to date. So still a very good number. Unfortunately, not the 45% gain that we had with last week's show, but nevertheless, still a pretty good gain. And I think we're quite well positioned as we sit right now with this structure.
Yeah, well, it's going to be interesting times into the end of the year, I suppose. Garth, we have to leave it there. But thanks for joining us, and well done on last week and keeping your head under pressure. That is Garth McKenzie, founder and editor of Traders Corner.
Traders Corner was proudly brought to you by IG. Visit igmarkets.co.za to open a trading account today.